Welcome to Truflation.com Twitter Spaces. We are live and a day ahead of the official BLS CPI print for June 2023. As we speak, markets are opening in anticipation of tomorrow's big day. I've really not seen this kind of anticipation and hype for quite some time. So it should be really interesting. Danielle DiMartino Booth offers her apologies for not being able to make it today due to a personal matter, and we're sending her good thoughts, and we're working on a rain check appearance real soon. Our panel of this episode include the Truflation team, CEO Stefan Roost, head of data Ivan Yelik, and head of product Oliver Roost. We're honored to have guest speaker Omar Yahia, head of investments at ZK Sync and Matter Labs, and some more housekeeping here. Please note that we're live and that the episode is being recorded. After the panel weighs in, we'd love to get your questions and comments. So do either raise your little hand in the app here, request to speak, or just tweet at us at Truflation, and we'll pose your question to the panel. You are listening to Truflation.com pre-CPI discussion and analysis, sponsored, of course, by Truflation Premium, our comprehensive data service for investors, businesses, and those who wish to stay in the know. Surf over to Truflation.com and click the black download button to order. Let me go ahead and grab some of our guest speakers here as they're kind of coming in. Let's see. Moving them all in. Thanks again, everybody, for tuning in. We appreciate it. And just waiting for a couple more. It does look like the overall look here, according to our informal poll, is that everybody's expecting something like a 3.1% a print tomorrow in terms of the market consensus. But even Truflation, our followers are saying something like 70% of those polled that it'll come at 3.1% or lower. They're actually saying sub 3.1%. So that's really interesting. It's as good a time as ever to basically get an analysis of what happened over the last month. It looks like there's been quite a bit of talk about Truflation and its numbers relative to the CPI. But I think, again, everybody expects that number to come much closer to us than it ever has been. If you've been following Truflation, it's kind of a daily habit for most people. They'll get in here and really check it every single day. And in the morning, we print about 9 a.m. each morning in the U.S. and they'll check it. And we had probably our lowest print I think ever was July 3rd, if memory recalls, at about 2.21. So it got pretty low. But again, that means the CPI and BLS and even TradFi to a limited degree are coming our way. It's as good a time as ever then to hand it over to our analyst, rather our head analyst, Oliver Roost, and ask for your take, man, about June. What are you seeing out there? And thanks for coming on.
Hey, thanks a lot for having me on. Can you hear me okay?
Perfect.
Perfect. Yeah, thanks a lot for having me back. Great to be back and great to have so many of you around and joining us again for the June update. So yeah, I think the intro really covered it pretty nicely. Everyone is expecting a downward trajectory on a high level wise. I think this is probably going to be the last significant downward trajectory in a while. And so I think, we're going to start seeing numbers change a bit as of next month. The rate of decline will significantly drop, and if not, potentially even increase. So what's been happening in the month of June? Actually, quite a bit in terms of inflation. So let me give a quick heads up. Everyone is up to date, at least what we've been talking about. I think one of the key things is obviously the Fed's monetary tightening policies continue to bear fruit. as we're predicting, as Work mentioned, we're predicting the number to go from continue its downward trajectory from 4.9 to 4.1 to 4 in the last month, so another 0.9% drop, to go down another 0.9% drop. So we're expecting to come in at 3.1%. The consumer confidence numbers, as a result of the continuous drop in inflation, is improving. It's gone up 5% versus last month. We're seeing 11% growth versus a year ago. It's partly driven by availability of jobs, with the jobs report or the unemployment numbers coming out. I think, second of all, it's also driven by the combined downward trajectory of inflation that's fueling consumers' expectation on improvement of their own personal finances, and potentially also an increase in their disposable income as a result of wages increasing. Now, what is interesting is the greatest growth or improvement in the consumer confidence is amongst those under 35 and obviously earning an income about 35K plus. So it's certainly bearing fruit with the wages data, where you saw the wage increases predominantly affecting the hospitality industry. So we're expecting this downward trajectory to continue, as we previously stated. We're expecting to come from utilities, apparel, car purchases, gasoline, health, and communications. Those are the major categories for the downward trajectory. But I would have to add that we're not expecting the war on inflation to end, because this is the last significant drop that we'll see before things start to the rate of decline to significantly slow down. So based on the CPI coming in at 3.1%, which is probably, from a Fed's perspective, is probably one of the top one of the key indicators for that the monetary policy is working. But they're also concerned about the continued resilience of the U.S. economy. One of them, of course, is one factor into here is the tight labor market that's fueled by two factors. One is the increased wages, which has gone up from 5.4 to 5.7%. And of course, unemployment, which is argument's sake is stagnant, but it's came down by 0.1% from 3.7 to 3.6. I think, if you look at the unemployment numbers and the wage increases, I think, you need to take this data set with a pinch of salt for two reasons. Why the Department of Labor's unemployment number is lagging. Hopefully that's pretty clear with everybody. But I think, second of all, it's not only lagging, but I think the assumption that the Department of Labor is making is that the growth that's going to be fueling the economic growth in the future is going to be coming from the small, medium enterprise businesses. And certainly that's not the case, what we're seeing out of data that's either being posted through dailyjobcuts.com or through other websites where they're pronouncing that the SME decline has hit around a 30% year on year so far, right? And that's a significant drop in the growth. The second factor, of course, is this growth in this tightness of unemployment is predominantly in the service-based industry, right? Where comparatively to the finance and the crypto and the tech world, which accounts for only about 4% of the total employee workforce in the US, but they're obviously over-indexed on the income that they earn. And so we've seen continuous layoffs in that sector, but it doesn't really affect the overarching employment numbers as reported out by the Department of Labor. And I think will have a bigger consequential impact on the demand than what the forecast suggests by the Fed. I think then the next factor to consider is retail sales. Based on all this, retail sales are going up. And they're going up not only month to month, they're going up on year. And so starting to see some increases. Certain categories are growing faster than others, but certainly retail sales are on the up. The biggest concern around retail sales is inventory, and we're seeing some certain sectors significant increase in supply. And then finally, I think the other factor is the GDP Q1 forecast got its third and final revision or final estimate. And it improved from the second estimate of 1.3% and improved the GDP forecast for Q1 up to 2%. And that's probably driven as a result of inflationary increases, inflationary prices has driven that rate of growth increases up to 2%. So, I think if we break all this down, what does this all mean? I think we look at where the economy is going. We're continuing to see the services-based industries that are much more dependent on the labor market, which still remains tight, holding relatively stable, but still in a downward trajectory, compared to the price of goods, which is it's accelerating at a downward trajectory at a rapid pace. So based on all of that, where are we seeing some the key drivers for lower inflationary market conditions? One is utilities, which is in part due to the fact that we're entering into the summer months, and also to the cost of commodities versus a year ago. That's seeing a significant drop. The seasonality and lower usage in utilities is certainly something we expected. And that is certainly, if you look out into the future in Q4, that will certainly see a further increase as we go back into the end of the year. The second category is around gasoline. That has seen a 26% year-on-year drop, but it's still holding steady versus May. And again, expecting to see that holding steady for the remaining part of the quarter anyway. The other one is vehicle purchases, and we saw a significant growth in Q1 for vehicle purchases, and with the order financing, interest rates increasing, and general state with the excess demand or excess supply that the dealers bought in Q1, that supply now is in excess, and that combined with the auto loan and the increased interest rates on the debt of that auto loan having a significant impact. We're seeing the prices of cars dropping, and this is normally a high season for cars where we see prices surge in the summer months, and this is not what we're seeing at the moment. And the levels that's in the inventory in the pipeline on the dealerships, and on the lots is quite significant. So we estimate that's going to take quite some time for that supply to get flushed out of the platform. I think then you're looking into other categories like health, seeing that prices coming down. That's also in part because of the enhanced subsidies that were introduced in 2021 under the American Rescue Plan Act. And that has been extended now to 2025 and also expanded in terms of contribution, all designed to fight inflation. And then the major category that's seeing a downward trajectory in pressures is apparel, right? And that's because of weakening demand and increased competition. Particularly the markdown on prices have started a lot earlier in the apparel industry than we've ever seen, suggesting that the demand really is not there and the competition is just driving down the prices in the apparel industry. Beyond that, there are two categories that are forming an upward trajectory and they're bucking the trend. And one of them is an old favorite of ours, which is the housing category. That is not going anywhere. In fact, it's continuing to rise up. And that was a bit of a shock for us because we were certainly expecting the housing market to cool, especially with the 30-year fixed mortgage rates being at about high sixes, 6.7, 6.8 in the end of June. That number now has increased to 7.3. But the numbers are corroborated with other data sets as well, not only in terms of the number of sales of new houses that were made. That number continues to rise on an accelerated basis from September, when it was at not low, but in September it was about 670,000 sales per month, to now in May it's now reached 760,000 sales in May, and that number has been going on the rise ever since September. On the other impact of the cost prices on the owned property, of course, is property tax. That varies from state to state in terms of the impact it's having. The most dramatic impact has been in Florida, but overall, that's having a consequential impact on owned property and the premiums they have to pay accordingly. However, though, even despite the increases that we're seeing in the property prices, we're expecting that to start cooling. One is on part I mentioned because of the 30-year fixed mortgage rate. And second of all, I think the major factor why we would expect to see a cooling of the housing market is increased supply. And if you bulk the supply down in the housing market, um, you can bulk it down to three types of supply. You can either bulk it down to new residential areas asking for permits for construction to begin or construction to happen. The second one is the types of the residential areas or residential construction that has commenced construction, and then finally the third area is residential supply that's coming onto the market and it's completed construction. And in 2023, and especially in the back end of 2023, it's starting to come online now, but especially in the back end, we are going to see the highest number of volume of supply coming onto the market than we have seen in the last 15 years. And so it's going to really have a significant impact combined with the interest rates and the fixed mortgage rates to drive a downward trajectory on the housing market. I think you couple that with AirDNA has also reported out that there is about an increased availability on Airbnb and Vrbo by about 12%. Obviously varies by market. Gives you an idea that both the rented and the owned properties should start to see a downward trajectory. The other category that is bucking the trend, for this month is a reversal in the trends, is food. And in fact, food we break down into either food at home or food away from home. So food at home, we are starting to see prices have increased month on month for the first time in a while and have gone up 0.8%. And that's in part being driven by either the increased tariffs for importing products into the US. It is either being attributed to lower crop yields due to natural causes, be that the wildfires, etc. And also, of course, higher labor costs. There is some continued bottlenecks in supply, but that's still a minimal impact in the food category. The other factor is, of course, food away from home, where we're seeing an increase of 0.4%. And that's in part because of the confidence of the consumers. And it's also consistent with what we're seeing on our credit card transaction activities through ShopTrend. And they're seeing an increased transaction number and transaction size, not only an increased spend of 4.2%, but we're also seeing an increase of transaction size of 1.8%. So certainly greater confidence is fueling that. But going forward, there was the CEO, I think it was of General Mills, that just recently announced in their earnings call that they were expecting to see an increase in food at home. And he was quoting a number of saying a 4% growth of people eating at home today versus 3 months ago. So some interesting stats there, and he also talks about the spend that people are willing to make away from home in the groceries compared to going out for at home at dinner. And they had a calculation that says going out for dinner costs 3 times more expensive than eating at home, and so people need to economize and need to budget as a result of the higher interest rates and paying off the debt that's associated with that, be it on the credit cards or the loans. That will have a significant impact. So where does that all leave us? And I'll quickly sum it up with these last 2 comments. We are obviously projecting right now our short-term forecast for June data at 3.1. We are, however, expecting a Q3 number to come in at 2.5% and a full year number to come in around 3 to 3.5% as well. So we're starting to see the dip coming in Q3 and then prices to accelerate again towards the back of the end of the year. So I don't think the war on inflation is over. And for a number of reasons that's causing that. beyond just the labor markets we talked about. We talked about utility. We talked about the destocking effect and where that's going to start coming into play. And I think more importantly, actually, the other factor that's going to hit this, especially amongst the younger generation, is the student loans, right? And with the Supreme Court throwing Biden's bill in the can to apportion the student debt, that certainly is going to have another consequential impact on inflation in the back end of the year. So that's about it. I don't know if anyone's got any questions or any comments from Sosa or from Stefan or from Ivan or from Euroic. I'll hand it back over to you guys.
Yeah. So thank you for that. That was Oliver Rust, head of product out of Truflation, with a June analysis. You can get it if you missed any part of that and want a deeper dive still, charty and mathy and all that good stuff. Head over to truflation.com, click the resources button, and go to the blog section. And Oliver's in-depth analysis for June is there for you. And you can either read along while we're talking or formulate a question from there. To give Oliver a breather just real quick here, it's a good time as any to check in with Truflation CEO Stefan Rust. Hey, Stefan, congratulations, man, on the pub and the shout outs. The Truflation team earned a bunch of them since we last spoke. The All In podcast is talking about Truflation. Kathy Wood is talking about Truflation. Ivan on Tech, even DJs are talking about Truflation. And of course, Danielle DiMartino Booth said that Truflation tracks 97% here with historic BLS CPI data. So, well, and then if all that wasn't enough, we got something like 2 million views on a recent tweet, just a basic CPI print tweet. So neat stuff happening. That must feel pretty great, right, Stefan?
Yeah, no, thanks. And thanks everybody for the support and the continuous shout out. You know, I think a large portion goes to the credit of the team that's been working tirelessly to make sure we provide bulletproof numbers. We provide and source reliable data. We get it real time. We update it real time. And you know, I'm just super proud to be a part of a team that's really building 24/7, executing, and demonstrating that we do have the foresight, the insight, and the hindsight to be able to go into the future and predict some of what the outcomes are. And it's been, I mean, it's been really rewarding. I mean, I never thought that inflation would stay such a hot topic. And it's amazing, you know, it's like amazing. I don't know, they just had the ECB forum, the European central bankers invited a whole bunch of bankers from Japan and from the US as well to join a panel. And how, you know, they're enjoying the limelight, you know, these non-elected officials who are defining, you know, people's jobs and people's lives as if we were on a chessboard. And you know, they're just enjoying the limelight, and it's great for us because we're trying to provide an alternative source of truth. And yeah, the market is recognizing we don't work with stale data, we work with active real-time data. So excited, and excited of what's to come. Wait till you see all the data that we're going to be publishing in the very short term around all the activity that we have and all the insights that Oliver and his team are working with.
You are listening to Truflation.com Twitter Spaces, the pre-CPI, BLS CPI print that is ahead of that tomorrow. We've got a stellar panel that includes, of course, Omar Yahia of ZK Sync and Matter Labs. He's head of investment out there. Omar, you've heard a bit of the commentary, Oliver's in-depth analysis. You're in tech. You're a investment guru, Web3 guy. How does all of this stuff play into, I guess, your calculus and how you're thinking about things these days?
Sure, and it's a pleasure to be here with everyone as always. I did actually have a few comments on some of the analysis particularly when it comes to this idea that we're anchoring to a few key metrics, unemployment being one of them. We see a large divergence, particularly outside of the US, between unemployment and productivity. And I think ultimately what you care about is productivity. It's the marginal output that you get from hiring a new employee. And I think that by just considering retail aspects as well as overlaying unemployment, you have to remember that when firms hire, when startups hire, when we hire, we're not just looking at the instantaneous change in productivity, but we also try and factor in, well, what is it going to cost us to hire in 6 months, and what's the lead time for that, and do we expect more or less competition on the hiring market? So I think it ends up being counterproductive just to anchor the expectations just purely based on unemployment, because if you start digging underneath the details, you'll see that the picture that is reflected, the macroeconomic picture, is very, very different, particularly at the SME level, which is something that Oliver has mentioned. So let me throw back a question at the analysis. Given the key metrics, Oliver, that you highlighted, what are you thinking in terms of the actual state of the economy versus the headline state of the economy?
Yeah, I think I don't think it's as healthy as the headline data says, and that's certainly the case. But I think the question is how big a gap is that delta, right? And if you look at the GDP numbers and the fact that's taking into account inflation, where would that be without that contributional impact? Where is the growth engine of the economy going to come from if SMEs are not in the same situation as we would expect them to be? I agree on the productivity and capabilities, but I think there's also reversing that. There's a significant growth and lack of labor in the hospitality sector. And as much as productivity matters in that space as well, it's probably to a lesser degree compared to other industries. And so I think overall, I'd say the economy is, in my view, where the economic situation is I don't think it's as healthy or as resilient as the Fed thinks it is, and certainly not as healthy as they think it is from a metric point of view of where they are today.
You are listening to Truflation.com pre-BLS CPI edition. Here we're anticipating the CPI print for tomorrow and giving our breakdown and takes as to why we think it's going to be where it is. If you want to continue the discussion after Spaces and throughout the month, we're on many different socials, obviously Twitter, but we're of course at Telegram, where there's always a vibrant discussion going on. And then if you want to re-listen to some of these spaces, we archive them over at YouTube. So you can go there, Truflation as well. So taking into account all that's been said, is there any worry now about dis or de-inflation? We see a lot of that coming up in comments every day on Twitter, especially. Is there this is for anybody on the panel, really? Is anybody worried about the Fed maybe having tightened too much and kind of gone overboard?
I just want to add quickly to Omar's question around increase in productivity and then sort of associated with employment, right? I mean, there is a constituent out there that really believes we're going to go for a soft landing, and the Fed have mastered, this liquidity splurge, if you will. But, coming back to the point around productivity and tools, and you're seeing a lot of the manufacturing move across into utilizing robotics. Machines are taking over in the manufacturing category. You're seeing AI come into the white collar working environment. So all of these elements are beginning to play a role where the recovery and the job picture, I think, is definitely very distorted and not an accurate reflection of the reality and the hopes in terms of how quickly the economy will recover. People will start using AI tools as a means to improve the productivity of the desk worker. Desk workers don't want to go and work on a factory floor, don't want to go back into agriculture. It's too comfortable sitting behind a desk and a computer, and especially if you can work from home, why would I want anything different? And how is that going to play out? I think we have no idea. And just regulating crypto, regulating biotech, regulating AI isn't going to be the answer to all of the needs, because there are going to be certain jurisdictions that are going to take advantage of it. How does that all play out? I think we still have a lot to see, and the windows are very murky.
Thank you, Stefan. And I'd like to also add the comment on the Omar's question. What is the actual difference between the headline numbers and the real situation? To be honest, we also have a feeling that there's a disconnect, the same way we did have a feeling about inflation numbers, that there actually is a big lag and there is something to investigate. That's how Truflation actually kind of started publishing the index. This is the same feeling we have with some other metrics that we are exploring. And even though we do have a feeling or a hunch about it, or internally how Oliver likes to call it, it doesn't pass the sniff test. We like to have the data behind it, and that's where the whole data team is working on, trying to push some other metrics that will be comparable to, or at least try to present the real picture of the situation of the economy. And then the second question is, or second comment would be on where are we going till the end of the year? And we also did play with that a little bit in regards to trying to see what are possible scenarios, not even trying to predict because it's quite hard, but to see what are the scenarios in the future. And if you assume that there will be no growth month over month in the next few months, we'll still see the inflation stagnating around 3%, and that will be scenario until the end of the year. So under assumption that prices don't grow, inflation will still stay at the levels of 3% or around, which is quite interesting due to the base effect that we have in the period that happened 12 months ago. So it will be quite interesting because we did pass the months where a year ago we had huge increases, where base effect was pulling the numbers down, or we had when we will probably have a big drops in headline numbers. But after this month, we'll probably enter into more stagnating period.
That was head of data out of Truflation, Ivan Yelich, with some commentary there. We've got a stellar panel waiting for your questions. The Truflation team is here. CEO Stefan Roost, head of product Oliver Roost, Ivan, of course, and a fantastic guest speaker in Omar Yahia. They're brains to pick. You've got them for free here on Twitter Spaces. So do ask your question. We did, and you can do that by raising your hand or asking to speak, and we'll put you up here, or just tweeting at us out at Truflation. Sergeant Major Hibari asked about a half an hour ago. And this is to anybody on the panel. I would assume Ivan, but it could be anybody, I guess. Can you go in depth in the daily rebalancing of the Truflation app data? Why are there some days where it corrects drastically versus other days? Hopefully that makes sense, LOL. And that is a question we do get quite a bit. So any light shown on that would be helpful. It could, I think we're at what 245 right now, and just a week ago we had again that low of 2.21. So it does fluctuate a bit. Anybody have something to say to that question?
So if you look at it from the pure data perspective, the daily numbers or the data sets that do get updated daily, the change will not be so significant compared to the numbers that do get updated on a monthly basis. So most of the housing data that we get are monthly. So you would see in a monthly change or new numbers for 30 days or 31 days and expect it to be more significant than the numbers that do change on a daily basis. So
that would be the main reason why we have some days we have bigger changes while others have 0.01 or whatever is a smaller change in particular index. So that would be the brief explanation.
And that makes a lot of sense. I think for a lot of us new to a daily CPI tracking with so many millions of data points, that there's something to get used to there. Trying to understand how the metric ebbs and flows. I think it's just going to jar people every time they look at it, and they're going to draw kind of, I guess, traditional conclusions from a new way of looking at data. So we've got to kind of readjust our orientation to that stuff. Would kind of be my guess. But thank you, Ivan, for shedding a little light on that. Again, we're looking for your questions. Jump in here. Request to speak. You've got a brain trust that is looking to answer you, and it looks like we've got a question rolling in here. I'm trying to connect the person. Yama, what say you? You've got a question to our panel. The floor is yours.
Yes, thank you very much. Ivan, I have a question for you. What percent of your data is updated daily versus weekly versus monthly?
Thank you, Yaman. And that's also one of the factors that impacts the previous question or the observation that some data does change daily and some does change monthly. So there are various weights or relative importances associated with various data providers. And daily data sets generally do have lower weights at this point. And as you would assume, the monthly data is, let's take an example, housing market or housing data, which in general has the biggest relative importance or the weight of the overall index in Truflation numbers. So it is expected that the majority of the data is related to the housing prices. So that has a bigger impact on the daily changes of the numbers. Hope this answers your question.
It does, thank you. And one more follow-up, if I may. Is there I'm not sure if I'm going to explain this right, but is there a bracket outside of which your number isn't allowed? Like, is there a maximum percentage that you can vary from the CPI number in your model? For example, if the CPI shows, I'm just making up a number, 7%, no matter what, your model won't show less than 5% or more than 9%, meaning that bracket is at about 2% off of CPI.
So there are definitely no brackets or limitations to the numbers that we spit out. The numbers that you see are exclusive result of the calculations and the data that are imported without any limitations in regards to having an algorithm that limits changes or the numbers or doesn't allow it to move, let's call it, freely.
Thank you very much. I'll move back down. Thank you very much for organizing this space.
Yeah, thank you for participating. Got another question here from Zach. Zach, you've got an all-star panel here. Whoever you want to ask, go ahead, Zach, and pose your question.
Thank you so much. This question can go for Stefan or anyone else who can answer the question. And it's more of a broad question related to speculating why do we believe that, like technology has been advancing fairly quickly. And I remember being taught in college, and this was maybe 2009, 2010, that every year the way technology advances is doubled in speed. So by the time you finish a 4-year program, 2 years into your program, everything you've learned is pretty much outdated and upended by new technology and new information and new data sets. Um, and that was over a decade ago. With that having been a standard for so long, since technology and the internet has developed, why do we think that it's taking so long for individuals or authorities in power that we've relied on for data to upgrade, to, I guess, look into technology to better their data sets?
Well, I'm not sure the question really. I mean, one thing is, I think well, I don't think, I mean, inflation would be super high if it weren't for technology. I think technology has allowed twofold. One is bring down the cost of productivity on the one hand, and on the other hand, has accelerated productivity as well. So we've seen growth in the economies thanks to technology, but at the same time, we've seen an improved output per capita thanks to technology. So it's had two different impacts. I think the impact over particularly the last, I'd say, decade is it's become societally, pressure on being an entrepreneur, being successful has, I think, is at the lowest point. We're slamming entrepreneurs that have been successful, have hustled to grow in off the back of technology largely. We've put them in their box. We've told them they can't run their companies. We've told them that they have to restrict, and limit their growth. On the flip side, in the financial services industry, it seems that we're trying to centralize a lot more around those specific economies and around selected institutions that are deemed systemically important. And so running a startup is really hard anyway, right? Growing a new business, growing a new economy. Now, on top of that, you're burdened with a lot of regulatory frameworks, a lot of new compliance hurdles. So in the end, not only do you have to find a partner to help you scale your business and grow and hire new employees and hire new talent in a new specific green field that was not necessarily known before, you now also have to hire the same lawyers to help make sure you comply with this new regulation and file this new application to get permission to go down a path and innovate and disrupt. And I think all of that has made it a lot more challenging for small, medium businesses to find niches to accelerate and to find growth opportunities where they can hire new talent. And I don't know, that's sort of just my feel. I don't know if that answers the question really. But yeah, I think just hiring an agent or converting a AI bot to help you do things where it doesn't require an employment contract, going through unions, getting approval for that unions. I mean, to me, you don't see software developers going on strike, but you see writers guild in LA go on strike. But ultimately, whilst ChatGPT might help writing and streamline writing, they don't have the creative input today. But a software developer whose code can easily be optimized and changed, they're not going on strike and they're impacted in the same way. So it's just societally, we're going through a whole restructuring and reorganizing of how we work and the jobs that are being employed and the talent that's needed to fulfill those jobs. And that change, we're seeing impact right now.
I guess more specifically, what I was referring to is kind of more like government authorities. For example, one prime example is how, I remember watching your videos and it talked about how the Fed is using a century-old model
Yep.
for getting CPI data. And I'm like, why haven't we updated that in over 110 years? Stuff like that, and we've stepped
Yep.
through two new ages since then.
Yeah, I mean, I can't answer that on behalf of the Fed and of the government, but I think the institutions are heavily dependent on, during COVID, 80% of new hires were done in governmental institutions or bureaus and departments. And ultimately, you don't want to restrict those departments because they could be your constituents that are voting for you. That's the only justification I can use. I mean, we would love to work with the government and leverage our real-time feeds to help accelerate some of the processes within government. And we've tried through multiple angles, and so far we haven't hit positive responses. Maybe that'll change. Maybe it just takes time for the realization to kick in, and for the people that have resources and influence to be able to make a decision that garners consideration around using modern data sets and modern technology.
Thanks, Zach. We appreciate the great question. Really a lot of food for thought there. And it got me thinking about, I just happened to, I think I was watching a CNBC. Yeah, I know. I was watching CNBC, and all of a sudden there's this lady from ZipRecruiter. I was trying to get some perspective on the ADP jobs report that had come out a couple days ago, and the ZipRecruiter head starts talking about how she sees more of her colleagues and the TradFi world kind of moving into online metrics and private data because it doesn't have that lag, to Zach's point. And the host basically turns towards the end, almost as an afterthought. So what are you using in these? You talked about private online data. Where are you getting this from? And she goes, well, it's Truflation. And she starts, and it was just at the very end of her segment. And so I think what we're probably going to see is we're going to see the private sector inevitably leads, right? It's they're out there innovating, however imperfectly, and they're doing their thing, and so they don't have time to mess with fads and constituencies and favoritism. They've got to get the right data because evolutionarily they lose if they don't get the right data. So it's slow, it's not as fast as we'd want, of course, but there is a real movement, and obviously I'm biased, but there's a real movement towards Truflation. And it's I guess the cliche is what a trickle and then all at once, and they're coming over, and it's every day there's something new, and it's in the zeitgeist, and it's moving there. Pretty soon something like Truflation, if not Truflation, of course I hope for Truflation, will become just the de facto center where they cannot ignore it anymore. So enough of my vamping here. Mo, I appreciated your comment about getting more people in the spaces. We got to
Crazy,
do
right?
better, but hopefully Elon will come in and goose us at some point and give us some love here.
Maybe Stefan needs to work on his marketing team. But yeah, first of all,
Go ahead.
good morning, gentlemen. Thank you for doing the space. My question is, with regard to the fact that you guys are covering the data on real time. I don't know what tools you're using to do so, but more importantly, when you have data that could be skewed, if you're doing it on such real time, how do you delineate that? How do you ensure? Because obviously you could have transactions that are out of whack, so to say. Do you take those? Do you factor those in, or do you avoid those type of data points?
I think Ivan probably.
And I'm sorry, I had a connection issue, so I don't know whether you covered that before.
No, we haven't. We got something to the daily fluctuations, but that's a pretty good question. Hey, Ivan, or whoever wants to take it, actually, what do you say to Mo's question?
So definitely we do have triggers and flags in our system. If something is 50% off of the yesterday's value, that's flagged and it's not taken into consideration. So the data gets updated on a daily basis. So this is a window where the QC procedures are done, and we ensure that the data that we get is a quality. So we work with vetted data providers, and most of the data that we do get is vetted multiple times and checked. So this is where we ensure that the one that is getting in and included into calculation is the one that's not skewed. We make sure that we follow and monitor the methodology of our data providers, what they do, how they treat the data, and we ensure that the data that get in is actually the quality data. Not sure if Oliver wants to add something in that regards, but I believe that's the most of it.
Yeah, no, that's pretty much the bulk of it. I think, we automate this process. We do a stringent evaluation criteria of each data set that we inject into the system. Once that's determined, which is all documented, we then run through each update that comes through goes through a automated QC procedures. And if it falls out of certain bounds parameters that we set for each of those data sets, then it raises a red flag, and then we go that red flag needs to be chased down. So yes, there are quality control measures in each of the data sets, but there's also extreme vetting that gets done before data is actually even added into the system, whether it's sustainable. In particular, sustainability is an issue, whether we can sustain it over a long period of time. So we don't want just a data provider to come in for 1 or 2 months and then leave again. So a lot of rigor and analytical work is done to evaluate each of the data sources, including the methodologies.
Does that answer your question, Mo?
Yeah, no, great work, guys. Keep it up. I hope you guys continue doing what you're doing. It's truly insightful and good to watch.
Appreciate it. Again, if you've got a
Thank
question,
you, Mo.
Sorry, Stefan, you wanted to say something?
No, just thank you. It's this kind of encouragement that keeps us going and gets us up every day and working 20 hours to bring this product to market. I think, we will do a better job on the marketing front to make sure we get the right kind of visibility, and the work we're doing gets the visibility it deserves. Thanks for that heads up.
Yeah. If you have a question, if there's something just burning, comment. What's your take? What do you think the print will be tomorrow? Is it significant? Will it be 3.1 higher, lower? What do you think? In the meantime, we've got a question in from Ms. AI. Please address the possible deflation in auto dealers. Surprised to see it. Was not expecting. Inflation, let's see if I can read here. Inflation, price gouge inflation is what I see. Thank you. I do think in the earlier analysis, Oliver actually singled out used cars. Do you want to say anything more to auto inflation?
Yeah, look, I think auto inflation is both used car and new cars. They're both. I think there's one exception to the market, which is the EV market, which is continuing to grow and expand. I think the estimates is that the EV market's probably going to own about. I think it's going to get up to about 11% market share, if memory serves me correct, based on the stats I've seen of the total sales of the US market, and that's a significant growth for where it's been. And where it was last year. So I think put aside the EV market, I think a lot of the other categories have seen an increased price, an increased surge in activity and sales in the first quarter of 2023. And then if you look at subsequent to that, the way they purchased a significant amount of supply, now that supply with the cost of managing the auto loans is seeing that pricing starting to come down. Not only are we seeing that in our data, we're also seeing that in Cox Automotive and Mannheim and JD Power. It's all consistent across the board that we're starting to see prices coming down. Obviously, it's a supply-driven issue, and it could be that prices are still high, but the question then becomes is what is someone paying for those after discounts and so forth. So I wouldn't say quite it's a deflationary market. That's not what we're saying. We're certainly saying it is the rate of increase is significantly dropping, and it's causing a downward trajectory, a downward pressure on the price increases that we're seeing.
You are listening to Truflation.com. pre-BLS CPI print discussion and analysis. We went through inch by inch, category by category here a little bit earlier in the show. So if you missed that, get out to Truflation.com, go to the resources section and click on blog, and you will see Oliver's deep dive into June. And that's a full day ahead of the government here tomorrow. We've got another question. Spider, come on in, brother, and let us know what's on your mind.
I just had a question about the jobs picture, and I know we've seen a lot of high-profile layoffs from large companies, and kind of wondering, like, are these people being laid off? Are they easily finding jobs that are similar, or are we seeing large-scale career changes? And then I understand there's a lot of money coming back home to invest in manufacturing here in the U.S., which should create a lot of manufacturing jobs. Are we seeing those types of jobs pop up? Are we seeing a shift into some of this maybe new economy that's forming?
Great question.
So let me give you a first bit of input. I'm sure Arthur's got a viewpoint here as well. To your first question, the number of high-profile layoffs that are happening tend to happen have a higher tendency, let's put it that way, to be happening in the tech and finance world, right? And and they are seeing have a disproportionately high impact on consumer purchasing power and also income ratios compared to the rest of the population. But the whole industry as a whole, as I mentioned earlier, only represents 4% of the total employment market. So, as much as they're getting a higher share of visibility of announcements in terms of contribution to the overall unemployment market, they are totally employable market. It's certainly a lot less. Where are they tending to come back? These are tend to people with higher incomes. What we tend to see in the past, and certainly, and this now is all arbitrary secondary information, but talking to a number of HR organizations, the estimation is that people are taking time off and waiting for the markets to recover, and then they'll be coming back into the market when things rebound again. Is that accounting for everybody? And this is all anecdotal, but is this going to count for everybody? Definitely not. Some people are going to make a shift change. Some people are going to take a longer term trip they wanted to do, whatever that may be. People might switch industries completely and look for a new role in a different sector. But there is as we've seen in the past, and also is confirmed, people are looking to also take an extended period of leave, so to speak. I think then to the second question about the employment market and sorry, can you repeat the second question? I've lost my thread on the second question. I apologize.
Yeah, the conversation about nearshoring and additional manufacturing here in the U.S. Like, are we seeing jobs start to crop up, or is that something that's anticipated that we should see more diverse jobs coming down the pipeline?
Yeah, I think it's certainly you can take a number of categories. You take the agricultural products, and I think China has got the biggest, and this is also the tariffs coming on the food categories. China is getting, I think it imports something like $5.4 trillion per year on agricultural products into the US. And that's obviously going to translate into more food products being produced in the US or imported from elsewhere. We're also seeing manufacturing coming closer to home. I don't know if it's all completely at home, but certainly coming closer to home, especially in the apparel industry. And that's seeing a bit of a shift as well. And I think that will have consequential impact on employment opportunities in the US. And will also change the dynamics of labor competition, because in certain categories already in the labor competition, we're already hitting, the bottom of what's available in terms of employee workforce's availability. Is really, the supply is virtually at the rock bottom, and hence why some of the price points are certainly going up as a result in the wages. So not baked in yet, but I think that's certainly not seen yet. Sorry. And I think that's going to start impacting the numbers more significantly in the second half and into early 2024.
Yeah, and I think the onshoring is definitely going to happen, right? The nearshoring is beginning, but you're seeing, I don't know who was it, Oliver. We had that conversation, and factories that are deploying robotics inside the factories, especially in the automotive sector, have a return on investment in like 9 months. They're generating a yield that allows them to pay off the factories. So what does that mean? That's got to imply that the yield associated with investing in a new factory to nearshore is going to pretty, you know, pretty much guaranteed be using robots. And as a result, using robots, it's going to generate a return on capital of capital deployed in 9 months. If that's the case, where am I going to use people for in the manufacturing process, not looking at agriculture, but looking at largely the manufacturing sector. And so that to me is a sign that I don't think we're going to be hiring as many people as we think if we bring back manufacturing and put that onshore. I mean, how many people want to go and work in a widgets company developing or building new screws or washers for those screws? I don't think many people, it's not a very sexy job. Not many people will want to do that anyway. And it's going to be going into robots that are going to be doing that.
That's great. Thanks for the answers. And yeah, I didn't realize how far robotics has really come along for manufacturing. That's actually pretty crazy to hear. Thank you.
Yeah, it really is. Excellent discussion all the way around. You are, of course, listening to Truflation.com, Twitter Spaces, pre-BLS CPI discussion and analysis. You can find us on all the socials. Just look for Truflation. We are there to continue this discussion further. I want to end with our guest speaker, Omar Yahia, chiming in one last time for kind of your final thoughts here on all we've discussed, whether it's automation or the different sectors of CPI. How is that kind of impacting what you do, or does it? How much attention do you have to pay to this kind of stuff? And is it I guess relevant ultimately to what you're doing?
Absolutely. I think the most important point to remember about investing in venture markets in general is that you're typically looking at much longer time horizons. The perennial problem that most people try and tackle is, how do I predict the future? I don't think that that's particularly useful, because it's almost impossible, if not extremely difficult, to try and do this. Instead, what one should try and do is articulate the present. And so what we try to do on a continuous basis is try and understand, first, what is the state of reality? Who's got it right? The metrics, the headline metrics versus the underlying state of the economy, what different stories are they telling? And then we ultimately form our own story and try and understand what kind of sectors in the economy would benefit from a certain type of technology. And that's what ultimately informs our decisions. And so we typically find it almost counterproductive to try and focus on monthly or quarterly actions by the central bank or by fiscal or monetary policy in general. But instead, we try and think, okay, given the actual state of the economy, what should you long, what should you short? And by that, I mean not necessarily liquid equities, but rather what type of risks that you should underwrite. Now, I think it's interesting to draw a parallel between the situation that we have now and the situation that we had about 2 years ago, when the Federal Reserve very famously would say, we're not thinking about of raising interest rates, which was the sort of recursive statement on monetary policy, which became something of a meme at the time. The problem with that is, if you were to try and predict the future, well, it seems that the future was easily portrayed for you or set out for you by the central bank. However, the interesting part is that the majority of regional banks, as well as some of the bigger commercial banks, they did not try and articulate the present, but instead they just relied on that faulty prediction of the future, and they basically levered their balance sheets at ultra low interest rates. And we all know how that turned out, and we're still seeing the ramifications of that today. So all of this is to highlight the importance of, instead of trying to predict the future or be told what the future is going to look like, it's really important to try and articulate the present. If those risk takers at the time realized, we're rolling over hundreds of billions of dollars worth of debt, this is ultra low interest rates, should we be a little bit more conservative? Maybe we only deploy a fraction of that balance sheet at those rates, given that we're at historically low rates, which in hindsight seem pretty obvious. The thing to remember, again, is that when one is thinking about deployment and when one is thinking about risk taking, time is much better spent trying to really understand the current state of the market, and you do well by anchoring your biases to what you can articulate today, as opposed to trying to predict what's going to come in the future.
Articulate the present. Go ahead, Stefan.
Yeah, so just on that note, I'm always intrigued because Omar always has some wise insights, and super glad to have worked with you on so many different occasions. But on that note, right? So are you saying that, sort of, on the one hand, just work with what you know today, and if you want to change that paradigm, look into what other metrics you could use in the future, get to know that. Once you start knowing that, build that into what you know today so that you can improve your vision on what is actually going on today and how to make bets accordingly within your risk profile.
That's right. That's exactly right.
Yeah, interesting. So always be learning, always extend your horizons, but still stay within the framework of your horizons until you're comfortable that you've extended it sufficiently.
Very, very well put. Articulate the present. That's what we do at Truflation.com. We are daily articulating the present, and great sage advice there from Omar Yahia of ZK Sync and Matter Labs. Omar, how can people find you and keep up with your work?
I'm reasonably active on Twitter. You can find all of the wonderful stuff that we're doing at Matter Labs and ZK Sync all over Twitter and our GitHubs. And myself, you can find me on Telegram, Twitter. I have an aggregate Notion page with a lot of relevant content to what we discussed today with Stefan, Truflation, and all things macro, as well as all things crypto. Feel free to ping me on any of these platforms if you'd like to discuss, or if you have a particular original articulation of the state of the present, I'd love to hear it.
Very, very nice. Go ahead.
And there's an amazing podcast called Uncut that everybody should be subscribed to.
That too.
It's weekly, updated weekly, and it's a hilarious bantering and insight and alpha from Stefan and Omar. Well worth checking out. So that's our take, gang. Again, you can find the Truflation analysis right now on our blog at Truflation.com under resources. We're back live on July 26th for the FOMC and Powell presser. And on July 26th, we'll have a micro view. Speaking of focusing on the present, articulating that, and trading and investing, we've got the trader's view of Fed doings with expert investor Jonah Lupton of Lipton Capital. He is a stud, a really interesting guy, and I think you're going to love that conversation. Again, that's back here on July 26th with the Truflation panel. Keep it locked here at Truflation on Twitter for daily CPI updates, meme magic, fun analysis, and of course, get out to our Telegram to stay involved in deeper discussions as well. Thank you for your great questions. Pretty terrific panel, lots of engagement, and we'll see you again back here on July 26th at 9:30 a.m. Eastern. Thanks again, everyone. We'll see you next time.